Good afternoon. Thank you, Stephanie. I told Stephanie I think they should have had the active shooter speaker after lunch instead of the bond lawyer and the financial advisor. So we'll try not to put you to sleep. We are going to give you kind of a comprehensive look at TIF today. We're going to touch on everything from the basics about TIF. Well, we won't spend too much time on that. I'm sure you know most of that. Reporting requirements, recent legislation, monitoring TIF areas, reducing tax rates, impacts of TIF. We're really going to, Matt is going to really hit and emphasize the financial side and the mechanisms on the financial side from the auditor's perspective here. Let's see if I can work this thing. Okay, we're going to start with a few pictures. Why do we do redevelopment? Why is redevelopment important to our communities? You'll see at the top there, you'll see some downtown areas, and then at the bottom, you'll see an old dilapidated building. Basically, we do redevelopment to improve our quality of place, mostly downtowns, clean up brownfields, clean up dilapidated buildings, those types of things. And also, we would hope then that spurs additional new development because you've cleaned up the area and you have more developable land. Why do we do economic development? Why do we do a field of dreams and try to build an industrial park from scratch and things like that? Well, you have some of the obvious reasons. You know, you want to create jobs, you want to get increased wages, you want to build your tax base. One of the maybe not so obvious reasons is you also need economic diversity in your tax base. I was born and raised in Newcastle, Indiana, along with Stephanie back there, and Henry County. And when I was growing up, it was very, very heavily manufacturing weighted. And then obviously we know a lot of those things went out, a lot of those auto dealers and things like that. So then they really had a downturn, and they've worked very hard to come back and to create those jobs again in different ways. So now they have like a Boar's Head meat plant and those types of things. They have some food industries. They still have some TS Tech parts industries and those types of things. So you really need to diversify your tax base. So what are we really talking about when we first get started, or when you first got started? Everybody talks about TIF areas and specific types of TIF areas. But what did we do when your legislative body actually adopted that ordinance to create that redevelopment commission? They were just thinking about, well, let's go create some TIF areas. Well, what that ordinance also did was create a special taxing district. So you have if you have a TIF area, you have a redevelopment special taxing district. And what does that mean? Well, the boundaries of that area are coterminous, meaning they are the same boundaries as your county. Okay? However, if you have cities and towns within your county that also have a redevelopment commission, then they too have a special taxing district. So and it's coterminous with the boundaries of their unit. And so in your special taxing district as a county, it would exclude those cities and towns that have their own redevelopment commission. That becomes important if you ever issued bonds payable from this property tax levy, which some communities say they would never, never, never do it. We'll tell you why it's an important tool, at least as a backup revenue source. But if you were ever going to issue bonds payable from that special tax levy, you need to understand the tax impact. If you have a very large city within your county, all of those taxpayers are excluded, and that tax levy would just be on the county taxpayers. So your financial advisor would point that out and give you the impact, but you need to understand that. It's also, the Supreme Court has said that it is an exception to your county's constitutional debt limit. So if you issued bonds through the Redevelopment Commission payable from TIF or TIF and this special benefits tax, it would count against the redevelopment district's 2% statutory debt limit, but would not count against your county's debt limit. So they are separate. So you have your Redevelopment Commission. You've got your Department of Redevelopment that was created by that ordinance by your legislative body. Typically, a Redevelopment Commission is going to be 5 members. Counties do have the option to go to 7 members if you wanted to do that. I personally have not worked with any counties that have 7-member commissions. I think they have enough trouble getting quorum sometimes when it's a 5-member, and 7-member obviously adds more people. The majority of those are appointed by the executive of the unit. So for counties, the Board of Commissioners, and the remainder are appointed by the council, the legislative body. They do have one-year terms. If you don't reappoint each year, they continue within that appointment until they are replaced or vacated. They can be removed without cause, and that's not the same for a lot of appointed bodies, but these people can be removed without cause by the body that appointed them. So if your Board of Commissioners are frustrated with one or two of the members they appointed, they can certainly remove them and replace them at any time during the year. I've had people think it had to be when you're reappointing each January, but it can be any time during the year. Same thing with the council, the legislative body. If you're frustrated with one of the appointees, then you can also remove that person and appoint someone else. The executive also appoints a non-voting school board member. They have a 2-year term, and they're non-voting, so they also don't count against the quorum. The legislature has looked in the past couple years. They're always looking at tweaking the redevelopment statute. This is one of the areas they've been looking at. Should we make that a voting member? And if they do that, then they'd probably need to go to 7 members because you don't want a 6-member commission. The Redevelopment Commission has some pretty broad powers, and it has a pretty long laundry list of those powers, so we've only put really the main ones here that we see used quite often. The first two, the ability to acquire and dispose of property, that's very, very valuable in the economic development world. And what's even more valuable than that is the flexibility that a redevelopment commission has that the county does not have. So if the county owns property and wanted to dispose of it, wanted to provide it as an incentive to a development, you cannot, as the county, dispose of that property for less than the average of the 2 appraisals of that property. The Redevelopment Commission, they have to go through certain procedures, and they do have to get appraisals, but they could actually sell that property as low as $1 under their statute, or anything in between. They can acquire property for more than the average of 2 appraisals if that's a part of the incentive to get the development. The county cannot do that. So they have a lot of flexibility when it comes to acquisition and disposal of property. Then you've obviously got, they can build structures, maintain, repair structures. They can contract for local public improvements. They can issue bonds and enter into leases. That is, though, only with the fiscal body's approval. At one time, there was a level of issuance of bonds that they could issue without any elected body approval. That was $3 million. The legislature has done away with that. So any bond issued by a redevelopment commission, regardless of whether it's going to be payable from this property tax levy or pure TIF or a combination, they still have to be approved by the fiscal body. And most of their powers at the end say on terms and conditions considered best by the Redevelopment Commission. So they have a lot of leeway when it comes to those types of things. Some of their duties, these are the main duties, obviously to promote the use of land in the county that best serves the county. They have a specific statutorily expressed duty to cooperate with other governmental departments or agencies in a manner that best serves the county. And then they have a duty to combat blight. Again, those are the brownfields and things we talk about. What is TIF? I'm sure you know. It is a tool that captures increases in assessed value from new development. You can always, and it's automatic, you capture increases in assessed value for real property by going through the procedures we'll talk about to just create the area. In some cases, you can also capture increases in the depreciable personal property, which is the equipment. We're going to discuss that in a little more detail on a later slide, so I won't spend a lot of time on that. You generally cannot capture increases in assessed value for residential property. But when I say residential for the redevelopment statute purposes, I'm only talking about single-family residential. So that freestanding single-family home, you cannot capture increases in assessed value from that. We would always, if we are advising you when you're creating a TIF area, we would always advise you to keep those types of properties out of your TIF area. It doesn't matter if the boundaries of your area end up having to be an amoeba or it has donut holes in it. It doesn't have to be a perfect square, perfect rectangle, any of those things. The reason that we encourage you to keep single-family residential out of your TIF areas is, first of all, you get no benefit from the upside. So if that home does increase assessed value, you are not going to capture that, even if it goes over what it was when the base was set. But you lose if that assessed value drops below what it was when you created the area and set the base assessment date. So you create a hole in your TIF that has to be refilled from new incremental assessed value from eligible property. So it's also probably a little bit of a nightmare for the auditors to have to determine if they're in your TIF area, what's happened and what's happened with that property, what's it doing to your TIF, how much do we really need to pay out in TIF, those types of things. So we highly encourage you to leave it out. Other types of residential, though, certain types of apartments, condominiums, those types of things are actually assessed as commercial under the assessment manual. So originally this was a DLGF interpretation that because those properties were assessed as commercial, they're not what the statute meant by residential, because there is no definition in the redevelopment statute of residential, okay? The legislature then thankfully went ahead and made that change in the statute, so we don't have to depend on an interpretation that could change with different administrations. So that now is a statutory requirement or ability. Procedures for establishing a TIF area, well, we start with that ordinance of your legislative body that was adopted, I'm sure, many, many years ago. Create your redevelopment commission and your special taxing district. Then your executive and legislative bodies appoint those members to the redevelopment commission, and then the real work begins. They really start looking at properties, at the land, at what's available, at what needs done, and they decide what would be a good TIF area or a good economic development area and then a TIF area. And how that starts is you start by preparing this economic development or redevelopment plan. What types of projects, you find your boundary that you think you want to be this TIF area. And then you think about what types of projects need to be done in this area in order to help spur development. And so any type of project that you would want to be able to do in serving or benefiting that area, you want to be in that plan, because according to the statute, if it's not in your plan, you don't have the authority to spend TIF on it. If it is in your plan, it doesn't mean you absolutely have to spend TIF on it. It may be a wish list that you never ever get to the last 5 projects, but they are legitimate projects that you feel need to be done in this area. So if it's not in your plan, you can't do it. If it is in your plan, it doesn't mean that you have to do it before you could do a different project. And you can always amend your plan. So once you have your plan kind of in place, now you adopt what's called a declaratory resolution. And this really is the living, breathing document that gets amended for years and years and years. This sets your base assessment date. So whenever you adopt that, property is now assessed on every January 1 instead of March 1. So when your commission adopts that declaratory resolution, let's say they did it today, the base assessment date becomes the January 1 immediately preceding the date that they adopted that declaratory resolution. So it starts that piece from that adoption of that document, not the full process. It starts with the adoption of that document. So that sets your base assessment date. You set out your map of your area in that document. You set out your statutory findings. We'll talk a little bit more about those. You set out your acquisition list. This is another thing that if the commission wants to acquire property at some point, whether now or down the road, that property, according to statute, has to be on the commission's acquisition list. You can't just go out buying properties and not have any kind of document that says what those properties should be, and they should be in your economic development plan. You can amend that plan to add properties or to add projects, add properties, those types of things, but it has to be in your plan. Then you go to Plan Commission approval. So the Plan Commission, their true statutory role is to determine whether the plan that the Commission has put together is consistent and conforms with the overall plan of development for the unit, for the county. I will tell you, I've seen some plan commissions use this approval to say they don't like TIF, they don't think you should be using TIF, they don't want to approve it. But the statute basically gives them the option of either approving it or telling the commission how it does not conform to the plan of development for the unit. And then it goes back to the commission, and the commission should have an opportunity to make it consistent and then go back to the plan commission. So it was never the legislature's intention to give plan commissions a yay or nay on whether they agree with TIF. But I've seen it done. It then goes to the legislative body at this point to say whether they agree with the plan commission, whether it's consistent or not consistent with the plan. So the next thing that happens is a notice of public hearing is to be published in the newspaper at least 10 days prior to the scheduled hearing, and a tax impact statement is put together by your financial advisors, and that gets delivered to the budget officers of each overlapping taxing unit, okay? And that's an opportunity to, if your commission believes that there is opposition, whether it's from the school district, a library district, conservancy district, if they're hearing rumblings that there is opposition to this, that document and the 10 days between when that is to be delivered and the public hearing is an opportunity for a redevelopment commission member and your financial advisor to sit down with that school superintendent or the head of the library district. Because oftentimes it's a misconception as to what they're really losing out on versus reality. And sometimes if you take the time to sit down with them and go through it, like if a city is doing it and you get the tax impact statement as the auditor and you're concerned and you get your council concerned and your board of commissioners concerned, then it may be an opportunity for that city's commission and financial advisor to come and talk to you and sit down and really go through what the impact to the county would be. So I give you that option as well. If you want more understanding of what the impact is, ask to speak with the financial advisor for that city or town. Then the redevelopment commission holds the public hearing, and they can do one of three things. Up here we say adopts the confirmatory resolution, but at that stage they can actually do three things based on what they heard at the hearing. They can modify the original declaratory resolution. An example of that would be if we had a community that had water and sewer improvements as a part of their plan, but the county was arguing with the water utility that provides water, so there were citizens that were concerned and did not want TIF to ever be used to improve water, make water improvements that were just going to serve this utility that's not cooperating with the county. And so that redevelopment commission at the end of that hearing deleted the ability to do water works infrastructure. So that's a modification. You can modify and confirm at that time, or they could rescind it. If there was complete opposition to this particular location for this particular reason and they felt like that was warranted, they could rescind that original resolution, and then that doesn't go any farther. At the end of that, then they are to record the declaratory with the economic development plan and the confirmatory resolution. They provided that document to the Department of Local Government Finance, and they also file that with you as the county auditor. Since you're the one who's going to have to administer, you should look at that when it's delivered to you. Is there enough information there for you? Is it just a map? Is it a map and a parcel list? It's supposed to be a parcel list with the map, so that you don't have to guess as to what parcels are in that map and what parcels are not in that map. So take a look at that when you receive it.
I'd just like to add one thing there. Lisa mentioned that you need to have it filed with the DLGF, and where that operates through is the TIF management utility and gateway. And you might have to work with the DLGF to get it unlocked if you're creating a new TIF area. If you're amending a TIF area, you're going to have to upload the same documents, but it's important to do that early on in the process, kind of as it happens, so that way when you're getting towards reporting deadlines, which I'll talk about here in a couple of minutes, you're not scrambling to find all these resolutions and whatnot. Just get them scanned in right away, get them uploaded, and that'll just save you time in the long run. And it also kind of forces you to take a look at it as well in the moment to make sure that you have everything you need to do your job, is start recording it in your software systems and whatnot. So I think that's a really important point in the process where you can kind of take a step back, take a look at it, make sure you have it all there, and then just handle that filing requirement up front so you don't have to worry about it down the line if it's a county TIF area. If it's a city or a town, you don't have to worry about filing it with the DLGF, but if it's a county TIF area, it's very much on you or a member of the redevelopment commission to take care of that filing, and you're the ones with the gateway access typically.
Good point, good point. Procedures for amending an area or amending an economic development plan or adding property to the acquisition list. It's generally the same procedure as creating a new TIF area. In the past, it was only, all you had to do was publish a notice of a public hearing, and then the commission held the public hearing, and that was that. Not for expanding an area necessarily, but for amending a plan and adding to the acquisition list. The legislature felt like that needed to have more teeth to it, more process to it, more elected body oversight to it. So they basically made it the same procedure other than when it comes to the notice of hearing that I'll talk about. So the commission prepares their amendment. They have an amending declaratory resolution prepared. It's amending that original resolution, but you don't have to make all the same findings. There are just a certain number of findings for amendments. You do go back to the Plan Commission. You do go back to the legislative body with respect to the Plan Commission order. But then, when I said before, you publish a notice of a public hearing and mail a tax impact statement, here you may be required to mail that notice as well to certain property owners. So if you are expanding your TIF area, then that amendment requires that notice of public hearing to be mailed by regular U.S. mail to every property owner in the proposed expansion area. And I've seen that be quite high in the number. So when you're looking at creating a new area, and sometimes you're thinking, well, let's keep it just this piece for now, and we can always amend it. You kind of look at the pros and cons when you're doing it. If you know you're going to expand it, and you're just making it small for now, just because you think that would be less opposition, when you first create it, all you have to do is publish the notice. Because every property owner is constructively notified when that notice is published in the paper. When you go to expand it, though, you have to actually mail it to their home, to that property taxpayer. If you're adding property to the acquisition list at this stage, you have to mail this notice of hearing to that property owner directly. I've seen a lot of confusion when you're expanding an area and you're mailing notice to all these property owners. They come to the hearing because they think you're doing something to their property, and they don't know what you're doing. So sometimes I would tell you, put a cover letter with the notice. So you're explaining, here's why we're notifying you. If you're putting them on the acquisition list, they may have some questions for you. But one thing I always say is that does not give the Redevelopment Commission any more rights over that property owner's property than they had before it was on the acquisition list. They don't have the power of eminent domain. They can't force a property owner to sell their property. They can't change the zoning. They have no control over any of those things. All it means is if somewhere down the road this property was potentially an economic development property, the commission might be interested in negotiating with the property owner and buying the property. That's all it means. It doesn't mean that they have eminent domain or they can come and take your property, but you get a lot of those questions at that hearing. So TIF and personal property, I said earlier that it's automatic that you capture increases in assessed value for real property. But when it comes to depreciable personal property or equipment, it doesn't happen automatically. It doesn't happen by default. And you can't do a blanket approval to capture increases in assessed value for equipment. You have to specifically designate each taxpayer for which you are going to capture increases in assessed value for equipment. You also are supposed to find that that is required to help retire debt necessary to pay an obligation. There's only certain types of property. It's easier to tell you what you cannot capture equipment for. Any kind of retail, commercial, or residential projects, you cannot designate that taxpayer, and you cannot, by law, capture increases in assessed value from equipment in those types of projects. But this list here, industrial, manufacturing, warehousing, R&D, processing, distribution, transportation, if you have that type of taxpayer come into your TIF area and you are going to do something to assist that taxpayer or to build improvements or something else and you're going to issue bonds, then you may want to think about capturing the assessed value, or at least some of it, from the equipment as well. As far as expiration dates, this is something that's just gotten more and more confusing, I think, as the legislature was making some changes back in '08. If a TIF area was established before July 1 of 1995, it's what the legislature now kind of refers to as legacy TIF areas. Before 2015, those areas did not have an expiration date. You could have put an arbitrary date in your declaratory resolution, but a future commission could always amend that. So it had no expiration date, and the legislature finally in 2015 said, enough's enough, we want expiration dates on these areas. So instead of just giving an arbitrary date, because there are billions of dollars worth of TIF bonds out there, so they couldn't really do that, they said the expiration for these areas is going to be the later of 2025 or the final maturity of obligations that are outstanding as of July 1 of 2015. And I think Umbaugh and Eismiller could tell you that that was probably the biggest 3 months of bond issuances I've ever done in my 24 years at Eismiller. Everybody that had a legacy TIF area was issuing bonds to go out as far as they could, which would be 25 years from 2015. So a lot of legacy areas now expire in 2040, but they at least have an expiration date, okay? If you didn't issue new debt in 2015, but you had outstanding debt, then your date could be 2028, it could be 2030. If you didn't have any debt, it's 2025. So that's pretty easy to figure out. If you established a TIF area after July 1 of 95 and before July 1 of 2008, then the expiration date was, and it still is listed in the statute as 30 years after the date on which the allocation provision is established. And I will tell you that there are interpretations of a number of words in that sentence. And so we come up with about 4 different scenarios as to what is the actual expiration date and what does expiration mean. Does it mean no more collection of TIF, or does it mean no more new assessment? So if you interpret it no more new assessment, then you could still, in your expiration date year, since January 1 is the assessment date, it gets assessed on January 1, let's just say, of 2025, and 2025 is your expiration date somewhere in the middle of that year. Well, that's for taxes payable in 2026. So you say, okay, it expired. I don't get the January 1 of 26 assessment, but I do get to collect the TIF that was based on my assessment before my expiration date. or you will find people who say, no, expiration means you don't collect any more TIF after this date. So you've got kind of two extremes, because there's about could be a year and a half of collections, 2 years of collections in between those two. So something to work with your bond counsel. Anytime you're issuing bonds, your financial advisor and your bond counsel are always going to want to establish the expiration date and the last date of collection of TIF, okay? And then finally, any new areas created today, they kind of fixed that interpretation problem a little bit. If it's created today, it expires 25 years from the date on which you issue an obligation payable from that TIF. So if you don't issue any obligations, if for some reason you get a good corporate citizen that comes in there and you're going to do some road improvements and things, but you have enough money in your general fund to do it, but you have other projects that you want to do down the road, it starts generating TIF from this new project. If you did pay-as-you-go projects, you never start that 25-year clock. I hate to say that with the State Board of Accounts in here, but you never start that 25-year clock. So as soon as you do, though, it's 25 years from that date of closing. So that helps one end of the interpretation on expiration, but it still begs the question, what does expiration really mean? Last assessment or last collection? So those are all still interpretations. Any questions on some of that material that we've talked about? If not, I'll turn it over to Matt. Yes, sir. The question is, how do you designate a taxpayer? You would go through the amendment process that I talked about. You would amend your original declaratory resolution. If this is happening, if they're coming in after you've created your TIF area and you want to designate them, you go through that amendment process. So you create an amending, you draft an amending declaratory resolution, and the amendment is to designate this taxpayer. And so in any kind of amendment, and I didn't mention this, so I'm glad you brought that up, any kind of amendment that impacts an allocation provision. So if you're expanding your area, if you're designating a taxpayer, anything like that, then a tax impact statement has to be done in the amendment process. If you're only adding projects to your plan or adding property to the acquisition list, there's no financial impact of that, and so you don't have to do a tax impact statement. So, okay, thank you.
There's another question in the back.
Okay, yes, one question. You mentioned that you encourage entities not to have residential properties in their TIF areas. What happens if we do have TIF districts that have residential houses in them? Would you recommend us working with the RDCs to remove those from the TIF districts? Is there anything to prevent us?
From a legal perspective, and I'll let you touch on the financial, you can go through the same amendment process to amend the boundaries of your area to remove those single-family homes.
Okay, thank you.
Yeah, I would recommend working with the Redevelopment Commission and taking a critical look at those areas and saying, you know, is the presence of 20 homes in this allocation area, does that really fit what you're trying to do here? Since it can only hurt the allocation area, there's not really, unless you have big continuity or contiguity problems, it doesn't really make sense to have single-family residential unless you think that area is going to maybe be torn down and redeveloped down the line, things like that. There are certain situations where it might work, but you want to take a critical look at it and say, does this contribute to what you could say the greater good of what you're trying to accomplish with this allocation area? I hope that answers the question. All right. Feel free to interrupt me throughout. Raise your hand if you have any questions. I know some of the things I'm going to be covering are items you deal with a lot, including the first piece, which is the annual requirements that are associated with redevelopment commissions and tax increment finance. These are some of the reasons why I or Jason or Andy might be calling you and bothering you, hounding you for information on an annual basis to get some of these things done. So I know you deal with all of these quite frequently. But really to start off, by April 1st of each year, the first big requirement, the treasurer of the Redevelopment Commission, and congratulations to all of you who have counties with county redevelopment commissions. You are the treasurer of your county's redevelopment commission. By law, the fiscal officer of a unit is the treasurer of the redevelopment commission. You're required to prepare a fiscal report for the redevelopment commission. The law doesn't really define what this fiscal report consists of. It's really up to you. Most auditors, most clerk treasurers, controllers, what I've seen is provide, just an update on fund balances, revenues, debt payments made, some of the basic information. Because really, 2 weeks later, you have a deadline where there's a lot more information that's required of redevelopment commissions, both on just general redevelopment commission activities and activities specific to each tax increment allocation area that you manage. And that April 15th deadline, it's the TIF management report. That's the one that's entered into the TIF management utility and gateway every year. There's a more comprehensive list of things that you need to include in that report. And it's primarily focused on activities of the redevelopment commission and in each tax increment allocation area from the prior year. You have to include items like the membership of the redevelopment commission in the prior year revenues and expenditures, report how much debt was paid down. A parcel list for each allocation area needs to be uploaded in a very specific format. So all of those items like that are required by April 15th of each year. So between yourselves working either within your own office or with your financial advisors to get the county's information together, you're probably getting hounded by clerk treasurers and financial advisors of the cities and towns as well, needing parcel lists and Form 22s, things like that. So it's a very important report to get done, but it provides that transparency to everyone who receives it and who views it as to, what are the redevelopment commissions really up to in that prior year? And I'm sure you get that question quite a bit. You can point to this and say, well, in this report, it outlines, here's what happened last year. So I think that that's a useful tool in the context of when you receive those questions. By June 15th of each year, every redevelopment commission should be acting to make a determination to determine what amount of incremental assessed value will be captured for the upcoming fiscal year. So this past June 15th, this determination needed to be made for 2019 assessed values. And this determination is where some communities decide, we don't need to capture 100% of the incremental assessed value that we could capture. We might pass through some of it to the overlapping taxing units so they can see the benefit of that assessed value earlier on in the process. And I'll get into a little bit more on pass-through down the line, but this is an action that is required. They need to distribute the notification of their action to every overlapping taxing unit and the county auditor's office. So you would know that they're intending to capture this incremental assessed value. And then they're also required to upload that into Gateway as well. I believe that gets uploaded, and through the budget utility. I think that's where it goes. So that's an important deadline as well that you need to keep in mind. And then by August 1st of every year, you have to have assessed values certified. But yourselves, and I'm going to get into neutralization a lot more in a little bit, you're required to have the TIF neutralization process completed. And as all of you know, this is the mechanism of adjusting the TIF base assessed value on an annual basis to account for the impacts of trending and reassessment. It's not always done by August 1st, but you want to be as close to August 1st as possible so you can get your values certified as close as possible to August 1st. And like I said, I've got a couple slides to get a little bit more into the weeds on neutralization here in a minute. This past year, during the special legislative session that was completed on May 14th, the General Assembly passed House Enrolled Act 1242. And if you're looking this up, make sure after the 2018 you have the SS in parentheses, because if you don't Google it, if you just Google it, HEA 1242, 2018, it's a bill, I believe, on veterans benefits or something like that. So it might be a bit confusing. So you want to make sure that special session is accounted for. But what this bill did is it created a requirement for every redevelopment commission in the state to hold an annual meeting. For that annual meeting, they need to invite the overlapping taxing units that are affected by every one of the allocation areas that are impacted or that are managed by that redevelopment commission. So in Union County, you only have one TIF area, so that's pretty easy, pretty short list of overlapping taxing units. But in St. Joe County, the city of South Bend, that overlaps with multiple school districts, multiple townships. It's going to be a bigger crowd at that meeting. So you want to prepare for that accordingly. But you have to have this annual meeting. The governing body of any of those overlapping units could also request that a member of the redevelopment commission attend their own meeting. But at this annual meeting, the redevelopment commission has to address the following items: their plan for their longer term plan for the allocation area, for each allocation area, the budget for the expenditure of the TIF revenues, and the impact of each allocation area on each of the overlapping taxing units. There is no guidance really in the law beyond what is written on this slide. I didn't take it verbatim from the law, but I took it pretty close. The law doesn't really specify an agency on the state level that has jurisdiction over this requirement. So in my discussions with people in different areas, it's really going to be up to each community to define on its own how it will meet these requirements. So I would recommend that as you're planning on scheduling this meeting, determining what you're going to do in this meeting, consult with your legal counsel, consult with your financial advisor, and figure out what's right for our community to address these items. Because what's right for DuBois County and right for the city of Jasper, the county doesn't have any TIF areas, but for the city of Jasper, it wouldn't necessarily be the same thing that's right for the Gibson County Redevelopment Commission. So everyone needs to approach this in their own way, working with their own professionals and internally to figure out, how do we best address this need? And like I said, this is brand new this year. The law was effective July 1st of this year. So you're going to start seeing, you should start receiving invitations to these meetings, reading about these meetings, hearing from your redevelopment commissions, because this is something that, that needs to be done. And, it's something, to me, it's increasing transparency, increasing engagement of redevelopment commissions with the overlapping taxing units so everyone can understand how these TIF areas are operating. So I guess in my humble opinion, it's a good thing because you want to be engaged with everyone so everyone in the community can have an understanding of what's going on. Now, just to get into a little bit of the basics, and really this group here is the linchpin of how TIF is collected. You establish your allocation area, and it's important to note that it's the allocation area is where you're capturing the TIF or the incremental assessed value and generating the TIF revenues. You might hear talk of redevelopment areas or economic development areas, and a lot of times the allocation area is coterminous with those, but not always. So when you're talking kind of in the classic sense of what is a TIF area, you're usually talking about an allocation area, and that's where the property tax revenues are allocated to the redevelopment commission for the special expenditures. So you establish the base assessed value, the existing increment or the existing assessed value, that base, it remains in the tax base of the overlapping taxing units as of that assessment date. We always kind of say it's locked in as of that date, but really we all in here know that's not necessarily the case because you have the annual neutralization that adjusts those bases up or down. Now, personal property, that is locked in. That's not subject to trending or reassessment. As if it's $1 million of personal property base when the area is established, it remains that into perpetuity until the area expires. So you're only capturing the increases in assessed value over the base value, and those increases are generated by what I like to call TIF eligible increases or decreases, things like new construction of a manufacturing facility or a commercial facility, abatement expiration, the change in tax status. If a church gets bought by a private enterprise and turned into a taxable use, that increase in assessed value can be captured. Likewise, if a church buys an old storefront and turns that into a church that's tax exempt, that loss counts against the incremental assessed value in the area. So you want to constantly be cognizant of the TIF eligible changes in assessed value in your area. That incremental assessed value is multiplied by the tax rate, pretty straightforward. There's no special tax rate for TIF areas in Indiana like you might see in some other states. So it's multiplied by the tax rate, that incremental assessed value, the revenues generated off of that, gets allocated to the redevelopment commission for expenditure within that geographic area or to benefit that geographic area. As Lisa said earlier, and we'll emphasize this again, the act of establishing an allocation area or an economic development area gives the redevelopment commission no more power over the property or property owners in that area. You know, like I said, the taxes are going to be paid the same. Most of the time, a property owner, unless they're really in the know on local government, they're not going to know that they're in a TIF area because they don't see any difference on their tax bill. So that's important to note. It's simply that incremental increase in taxes is being captured and allocated to the redevelopment commission. Now I've got a picture here, just kind of the geography. Lisa already went through the nature of a redevelopment district, and then within that redevelopment district is where a redevelopment commission can act to establish an economic development area or redevelopment area, and then a tax increment allocation area where the dollars are collected. I like this slide because this shows just the mechanics of a TIF area in kind of a broad sense. You have the blue, which is the base assessed value that's set at the establishment of the TIF area. And it's important to note again, when you're establishing a TIF area, you're not taking away anything that those units are currently getting in terms of assessed value or tax revenues. You're only capturing the orange, the increases, the incremental assessed value that's generated over and above that base. And we do know that the base is adjusted annually. But really, you know, TIF is an assessed value tool at its core. And you're creating a TIF area, you know, to generate new investment, to incentivize a company, to generate revenues, to pay for infrastructure, to further develop an area. The end goal of a TIF area is for that TIF area to end, to get to that green spot where all of that assessed value is then added to the tax base, and everyone sees the benefits of that increase in assessed value. So I know a lot of auditors, your happy day will be when the TIF areas end, but I mean, that should be the happy day for everyone in the community, because that means that the TIF has served its purpose. That assessed value is now part of the overlapping taxing unit's tax base, and everyone's seeing that benefit. And I just have a couple more slides that just, again, graphically illustrate a little bit of how this operates. You've got the base net assessed value, you multiply that times the tax rate. That gets distributed to all the overlapping taxing units. That's just standard property taxes in Indiana 101. You got the barn there, everything's operating as normal. Then you create this allocation area, the manufacturing facilities are constructed, only that incremental assessed value gets allocated to the redevelopment commission. The rest of it, the barn, still goes to the overlapping taxing units. And one thing that's important to note is if that barn gets torn down, if that's a $100,000 barn and it gets torn down, that $100,000 of assessed value that was in place when the area was established has to be filled in by new assessed value before $1 can be generated in incremental assessed value. So if you're creating a new TIF area or a new allocation area and you know there's going to be a lot of demolitions in that area, you want to kind of think about that and how is that going to affect the TIF area? How is that going to affect your goals of generating revenue? How is that going to affect the overlapping taxing units? Because if you create an allocation area and then immediately a building is torn down, you're going to start off in the red because you've already lost that $100,000 barn. So you want to be thinking about things like that when you're going through the process of creating or amending an allocation area. And that's when you might get a call from someone like me or Jason or Andy saying, well, I've got this parcel list and I need the land and improvements value for all of these parcels. And that's assuming we can't get it off of GIS. Because you're trying to figure out, is there a potential exposure of losing assessed value before the TIF area even gets started, where you have to fill it in and that hurts what you're trying to do. Now, TIF-based neutralization, everyone's favorite thing that I have to work with them every year on and bother people with questions. What is TIF-based neutralization? I think that's an important place to start. And forgive me for looking straight at the slide. This is kind of a dictionary definition we've come up with. It's the process of adjusting or neutralizing the base assessed value of real property in an allocation area to account for the effects of annual real property trending or reassessment. Basically, it's the mechanism of ensuring that the TIF does not unduly benefit or suffer from trending or reassessment, and it protects the tax base as well. So if that barn is reassessed and it's $150,000 now and not $100,000, that's not a TIF eligible change in assessed value. The tax base should see that $50,000 increase. Likewise, if that barn gets reassessed or if that taxpayer appeals their base year assessed value, and it decreases to $50,000. Well, if the TIF area wasn't established, that $50,000 loss in assessed value would have been felt by the overlapping taxing units. So the neutralization process provides that mechanism to adjust that base to account for the effects of things like that. So it's crucial to the operation of TIF and to ensuring that the units and that the TIF area are being treated fairly when accounting for annual trending and reassessment. Now, how is neutralization accomplished? You're completing that neutralization worksheet. Either yourselves or your financial advisors or the cities or towns' financial advisors are completing those worksheets. And then once that worksheet is completed, down at the bottom, there's a little bolded box, bolded line item, that's the neutralization factor. And you apply that to your allocation areas. And all of those base values, whether it's a 1 parcel TIF area or a 100 parcel TIF area, get that neutralization factor applied to them. You multiply that base value times the neutralization factor, and then you get the new base value for that parcel moving forward. So when we say it's locked in, it's not really being completely reflective of what's happening, but it is, the spirit is that it's locked in, but you need to adjust for those items that aren't TIF eligible. Now, I want to get into a few spots for TIF-based neutralization, just some best practices, some things to keep in mind. And I always say that the neutralization process provides you with an annual opportunity to make sure that your TIF area is operating the way it should, that all the parcels are properly identified, that splits and combinations are being caught, that all the growth is being properly accounted for. I've worked in counties before where we were looking at the growth in an area, and we looked at it and said, I thought a new building was built. I thought it was a big new building that was built and should have been first assessed. So we asked the auditor. The auditor asked the county assessor, oh, well, we just didn't feel like assessing it. And this is almost verbatim what the assessor told the auditor. We didn't think it needed to be assessed this year, so we'll just take care of it next year. It was like a $5 million building. And that auditor called us and said, well, what do we do? I said, well, I know that the County Redevelopment Commission was kind of counting on the revenue to come from that building, so I think it needs to be assessed and it needs to be rolled into the neutralization form and captured. So they got the assessment done and everything has operated just fine since then. But that's your opportunity to find things like that that are happening and make sure that everything is being captured that should be captured, that losses are being properly reflected too. I know that that's what we use that neutralization process for is, we try to keep up on things throughout the year, but there's only so much we can do. But when we do the neutralization process, we're sitting down, we're looking at every single parcel and figuring out, was there growth? Was there not growth? We're sending you questions asking, was this new construction? Was it an abatement rolling off? Quantifying all those things. Or, I thought that this parcel should be in the area. I see it's not. And sometimes parcel splits aren't picked up in the software. So that provides you with that opportunity to really make sure everything's operating well and to work with those units that you're working with as well to make sure that it's all operating as it should. So here are a few best practices. Track all of the amendments and confirm the parcels, throughout the year. If you don't get a parcel list, ask that unit for a parcel list. As Lisa mentioned, it's not required, but by all means, it's a best practice. Get a parcel list together. I know every new TIF area I work on personally, and I think my other colleagues at Umbaugh are the same. We say, let's get a parcel list together. Let's get this to the auditor sooner rather than later so we avoid any issues down the line. Because I'm sure a lot of you have been in the situation where, late in the year, you might have been through neutralization. You get a declaratory resolution of filing for an amendment or a new TIF area. They're like, we did this back in January. We're just getting this to you now. And your head probably wants to explode. So you want to make sure to get that earlier rather than later. So just, if we're working on it, reach out to us, reach out to your redevelopment commission, legal counsel. Just try to get that early on and then make sure everyone's on the same page in regards to the parcels in that area. Also monitor allocation areas for parcel splits and combinations. I know it's a lot better now than it used to be, where parcel splits and combinations, it was common when early in my career, software didn't automatically pick those up. So every year you're trying to figure out, all of a sudden there are all these parcels that weren't in the TIF area that should be, and you're trying to figure out should they actually be, and you have to figure out, this was a new parcel because it was split off of a parent, or several parcels were combined, this is the new parcel number. Just try to keep track of those as best as possible. The software does such a better job now than it used to. But I've still, from time to time, find circumstances where some splits or combinations weren't picked up. So you want to be aware of that and keep an eye on it. If just during the year you're aware of new development that's going on in areas that you're familiar with as being TIF areas or allocation areas, flag those. And just so down the line when the neutralization comes around, you can make sure that that's being captured. And the same with demolitions or changes in tax status. Just write yourself a little note, put something somewhere where you can look back at that and say, oh yeah, that's why this parcel changed in value. It'll save you some pain down the line. And you know, in many circumstances, you're all driving by these on a regular basis. You're seeing the construction happen. You know what's going on. So it's a big help to yourselves and then to the professionals who work with you to have that information handy. And then also, if you do have a third party, someone like Umbaugh or another financial advisor preparing the neutralization worksheets, I would recommend just yourselves take a look at them. Make sure that to you they make sense. If you see something that, how did they come up with this much in growth or this much loss or this much in abatement roll-off? Ask a question. I never will hesitate to answer questions about work that I've done or reviewed, just to make sure that everyone's comfortable, because you know the auditor is the one signing this document. You should be comfortable with what you're submitting and having signed. Following the approval of the neutralization worksheets, compare the new base and incremental assessed values to what was calculated in the neutralization worksheet. I know that's one thing that we do on every area we work with. We always ask you, please send us the post-neutralization reports. That's what we're doing, because if there's a big difference, we're trying to figure out, okay, what happened here to cause that difference, and do we need to fix something? Reallocation, that's a hot topic for a lot of counties. You're all familiar with a lot of the software companies. What they'll do is if there are any negative incremental assessed value parcels, they reallocate base throughout the area to make sure that there are no negative incremental assessed value parcels. So if a parcel has an NAV of $50,000 and a base AV of $60,000, that $10,000 of negative base will get reallocated in a special column to make sure that no parcels have a negative incremental assessed value. We've had, you know, there are all kinds of philosophical discussions you can have about that. But you want to make sure that you're not you know, that you could be capturing residential when you're not supposed to capture residential. You know, Lisa talked about that. That reallocation could end up with you capturing residential parcels. You don't want to do that. What we've seen also recently is reallocation between taxing districts. And, you know, a little bit of reallocation, you know, $10,000, maybe even $100,000 if it's a huge taxing district, that's not going to have a big effect. But, you know, in the past year, we saw reallocations that significantly impacted the tax bases of the overlapping taxing units. Schools, libraries, townships, shifting, you know, tens of millions of dollars of assessed value from one taxing district to another. The incremental assessed value of the TIF area as a whole, fine. But the taxing districts see that pain, and you don't want to have that happen. So always look at those reallocations and make sure that they make sense, and work with your advisors to figure out what's going on, work with your software companies. And then also just track changes in net assessed values that take place between neutralization, certification, and abstract prep, because there's always corrections, late deductions getting added. Just figure out, is this something that necessitates us having to go back and fix something with the TIF? Let's see how much time we have left. All right, we've got about a half hour. Uses of TIF. We've already gone through this a little bit. Or is this is your slide, isn't it? Oh, I guess I'm on a roll. Uses of TIF. Any capital project that is in, serving, or benefiting, or in some circumstances, if the expenditure of the unit is of the unit as opposed to the redevelopment commission, if it's in or physically connected to the economic development area or the redevelopment area, that's what you can use TIF dollars for. So you got to remember capital in nature. It's very important. There have been communities, multiple communities, that in the past had used it for operating costs, and they got dinged by the State Board of Accounts. The town of Munster was one that took it all the way to the Indiana Supreme Court and lost their use of TIF dollars for, I think they were doing maintenance mainly, but yeah, park maintenance. So you really want to be cognizant it's capital expenditures. So it's building new things, or, you know, widening roads, things like that. You want to make sure that you're being consistent with the intent of the law. Examples, it really ranges any sort of public infrastructure. Roads, and that includes right-of-way, drainage, rail crossings, land acquisition or development. You can use it to assist a company with the purchase of equipment or construction of a new building, or the construction of a municipal building for that matter. Police, fire stations, that's become a big use lately, is using TIF to benefit public safety. I worked with the city of Monticello a couple of years ago with Lisa on a new fire station, and they used TIF to pay for that new fire station because it serves that larger economic development area and allocation area. Utility improvements are also classic uses of TIF: water, sewer, stormwater, extensions or improvements to existing utility infrastructure. Another one that's a newer use, but it is authorized in state law, is educational programs. Finding ways to partner with local educational institutions to fund programs that would benefit the workforce for employers in the area. Gibson County used TIF dollars to subsidize a welding program at Ivy Tech in Princeton, and those welders go on to work at Vutech and Toyota. So that's a natural interaction, and there are more and more communities looking to partner with their local school districts to utilize TIF as a tool to help with the education process, because they're recognizing that, without a qualified and thriving workforce, it's going to be hard to attract new employers to the area or even maintain your existing employers. I'll let Lisa address the items on findings and fact-sensitive analysis because it's more of a legal item. So. Oh, sure.
And maybe it's just me, but when you talk about negative allocations in certain areas and shifting them to other units, or I guess you lost me there. Why would that, first of all, why would that happen? And shifting it to another area, aren't you hurting the other unit, or am I missing something?
That's a good question, and I think your question is really at reallocation of base that I was talking about. And why would that happen, and doesn't that have the potential to hurt units? Again, the way the software programs are set up, and they're software vendors who can talk a little bit more about why in particular they do this, but it's set up where no parcel should have a negative incremental assessed value, where the base exceeds the net. And so in order to handle that issue, and let me emphasize, it is possible, and it happens frequently, for for parcels to have base values that exceed their net assessed value. That can happen for any number of reasons. It's just something that happens. What the software vendors do is they reallocate that base assessed value to positive increment parcels, so they kind of absorb that loss. So for their calculation of settlement and whatnot, there's no negative increment parcels. You are very correct that sometimes if you have a TIF area that covers multiple taxing districts, if it's a city or a county TIF area that goes through 2 or 3 different townships, you have them all set up. It's one TIF area, one captured assessed value in the end, but you're capturing from those different taxing districts. So if you start shifting base from Center Township to Washington Township because you're trying to reallocate to get rid of all the negatives, Washington or Center Township might have a base value of $20 million, and Washington Township might have a base value of $15 million. And that should kind of maintain and be adjusted through neutralization. Well, what we have seen in some instances through reallocation, rather than just shifting maybe $100,000 from Center to Washington Township, which usually isn't going to have a huge effect. It's all kind of scalable. But we've seen $5 million shifted from Center Township to Washington Township. And what that does is, to your point, that takes away assessed value in the tax base of Center Township Schools, Center Township Library, and it grows artificially the tax base of Washington Township. So we've had to work with communities to figure out how, we understand why the reallocation happens, We just want to make sure that that reallocation stays as much within that taxing district as possible, so you're not shifting tax base from one township to another and impacting those taxing units, because that can cause significant issues with their budgets. You're going to get, I'm certain, would get angry calls from the school district, would get angry calls from the library. What happened? You know, we had one number and all of a sudden it's this, and you just point to the TIF area, and it's another reason for people to complain about TIF. But it's something you really want to be aware of. And we had not historically seen huge shifts like that until recently. And so it's something that I know, as we've worked through things this year, really been hypersensitive to and keeping an eye out for that. And I would recommend whoever you work with, just keep an eye on that kind of thing to make sure it doesn't happen. How do you mean? As to why that would happen? The negative base assessed value, or the negative increment assessed value. You have a parcel that was set up with a building on it, and the parcel's assessed value with the building is torn down. Yeah, something that's the really simple. Or a church moved in and it's tax exempt now. So that's an instance of it. Thanks. Lisa, that's a good question.
Thank you. To get into a little bit more of the uses of TIF, as Matt pointed out, the criteria is quite broad there at the top. Any capital project in serving or benefiting the area. And as Matt pointed out, if the redevelopment commission is making the expenditure from TIF, then it's the in serving or benefiting. If the county makes an expenditure and then wants to be reimbursed from TIF, then the test is whether that project was in or physically connected to the TIF area. So the legislature has kind of differentiated between who is making the expenditure or who is issuing the bonds, because the county might issue bonds as the county in which some TIF is pledged to help repay that bond. EDC bonds come to mind. In that situation, that project, the test is whether it is, not only it's capital in nature, but is it in or physically connected to the area? So your bond counsel would always be looking at those types of issues. And again, they range from everything from public infrastructure to public safety to utilities, those types of things. We're going to talk a little bit more about findings, but I talked about the declaratory resolution and the statutory findings, and this is where you would make some of the findings about what the projects in your plan, how they serve and benefit the area if they're not in the area, if they're not just, you know, absolutely a slam dunk. And you'll understand why here in a minute. Some of the common ways, TIF is often used for economic development, to offer incentives to induce new private development. That's really why it was brought up in the legislature in the first place. A lot of it is used for infrastructure development and local improvements. Generally, that's done before you have a prospect coming in and you want to do an industrial park or some kind of office park or something. And so you want to encourage growth in a certain manner within that 100 acres and not just let them come and pick and plop down. You want to actually go ahead and build the roads so that certain parts of that industrial park or that office park are what are getting improved. Alleviate congestion, facilitate additional growth. There are a lot of road improvements. Noblesville, Hamilton County comes to mind. They have done a tremendous number of road improvements and road widening, et cetera, because of the traffic that's generated by the economic development projects that are in those areas. Something to enhance an area, fire stations, police stations. Vehicles are getting a little bit of a different interpretation, so when you're talking about public safety, talk to your local council, your bond council and others, and make sure you're going in a direction there that everybody's comfortable with. In common ways it's used in redevelopment areas, blighted areas, a lot of rehabilitation of utilities, sewers, downtown buildings, dilapidated buildings, those types of things. Also, they've used it to do parking garages to help bolster a downtown, because then you'll get some development when there's places for people to park and that's free and that type of thing. So that has also helped some downtowns. Keeping a close eye on how you're spending your TIF proceeds. this is what I wanted to talk a little bit about. As I mentioned, that criteria is pretty broad, and it is subject to interpretation. There's a lot of gray in it. Matt mentioned the Munster case. That Munster case actually went to the appellate court, and the Supreme Court denied transfer. But the appellate court did not agree with the way the TIF proceeds were used in that community. The Redevelopment Commission had built some park buildings and improved a park and things like that, which is quality of place. It serves a lot of your site selection. People are looking at what are your recreational facilities, those types of things. So those findings have been made. But then they transferred those improvements to the town. So then they were town-owned improvements, and then they were using TIF to do maintenance on those buildings and things, and the court did not agree with that. We believe that's a limited that case should have a limited interpretation, but it's getting a broader interpretation than I think the legal community thinks it should, but that's where we are. And so there's a lot of different eyes looking at how you're spending your TIF dollars these days. So obviously the Redevelopment Commission is going to be the first, they're the finder of fact. The courts defer generally to the finder of fact, but those days are no longer what they used to be. You used to be able to get a legal opinion that it served and benefited the area and was a proper use of TIF, and that's not necessarily holding as much water either. So you've got a lot of different bodies looking at this. You've got the State Board of Accounts, you've got the Department of Local Government Finance, and then your local bodies. So what I would tell you, and reasonable people can differ. Wait a minute, let me go back here. No, I'll go here. Reasonable people can differ on whether it's a proper use or not, and whether it's a creative use or whether it is an abuse. So when you're doing your declaratory resolutions or you're amending declaratory resolutions and your public hearings, make your findings, sit down, understand why and how it benefits the area, and why and how it is a proper use of TIF, and that it will encourage additional growth, et cetera, in your area. And then make those findings not only a part of your resolution, but present those findings at the public hearing, and make those findings a part of the minutes of the public hearing. You want to document everything to the best of your ability, because you're going to have other eyes looking at that information down the road, and you want to make sure, because at that point you've already spent it. So generally you want to make sure that everybody's comfortable. So some of your findings, the determination that it's in serving or benefiting, you want to support that. Provide justification if you're creating an area or expanding an area. Provide some justification as to why you believe doing that and accomplishing the plan will help encourage additional growth and create additional assessed value. And then obviously if it's an expense that could even be remotely thought of as an operating expense, you want to have some findings as to why it's not, why it is capital in nature, and maybe you look to your accountants to give you some justification for that. There is a part of the statute that does say when it comes to salaries, you generally cannot use TIF to pay salaries. But there is a part of the statute that says if you have a supervisory role over a particular capital project, so let's say you have a very, very large capital project going on that is TIF eligible, it's TIF proper expense, and you have a dedicated employee that spends a certain number of hours per day or whatever supervising that project and the grant that goes with it or whatever it might be, as long as you can document that and document those hours and have as much documentation as possible, the statute says you can use TIF to pay that supervisory expense. But you want to have it documented, and don't just say salary and here, this is how much it is, because that will get you dinged, I'm certain. And I think we're now back to the accounting portion. Any questions on that piece? Other than from Stephanie. Okay, thank you.
All right, well, just to kind of continue that theme, you want to keep constant watch over how those TIF bond proceeds and just revenues are being spent. And there are a variety of players in that process. Chief among them would be the unit's fiscal officer. So it's the county auditor, and then cities and towns could be the clerk treasurer, the city controller. But it really comes down to you making sure that it's all operating as it should. There might be members of the redevelopment commission who look to take an active role in that process as well. In the past, the treasurer could just be an elected member of the redevelopment commission. I still work in some communities where there are members of the redevelopment commission who kind of work with the treasurer, so work with the county auditor, work with the clerk treasurer to make sure that the redevelopment commission's on top of everything. If you have a bond transaction that has a trustee bank, then that trustee helps play a role in this, and that would be mainly with the expenditure of bond proceeds, making sure that those are being spent within the bounds of the trust indenture that governs the issuance of the bonds. And then also your financial advisor or municipal advisor, if they're advising on debt issuance, would have a role as well. There are a few communities that I work with where I help aggregate statements from trustee banks and then kind of put them in a little more readable format for the redevelopment commissions, and to just help them keep an eye on cash flows and project planning, things like that. So, the financial advisor can have a role in that as well. In terms of monitoring your allocation areas on an ongoing basis, beyond just monitoring the expenditure of funds, that goes back to our earlier conversation about neutralizations as an opportunity to really take a look at TIF areas to make sure they're operating as they should. You want to monitor your assessed values throughout the year. Look for big changes. Were there changes following certification? Why were there changes following certification? Do these changes following certification have any significant impact on your base or captured assessed value? You want to be cognizant of that as you move throughout the year. During the year, as you're doing your semi-annual property tax settlements, how are the actual settlements comparing with what had been estimated? And usually the abstract becomes the basis of kind of the overriding estimate of the TIF revenues. I have a lot of communities that I work with, and I know, Jason and Andy back there as well have a lot of communities they work with as well, where every TIF settlement we get an email from the clerk treasurer, because it's typically the cities or towns because you're more on top of kind of the background. But how does this compare to what we were expecting? And then we look and try to figure out, well, taxpayer XYZ, they're way short. Why is that? And then, was it an appeal? And just trying to figure out and proactively figure out why, where collections coming in behind or ahead of what you were expecting. And then were there any special circumstances that were impacting your property tax settlement? And your role as the auditor, just communication with the establishing entities. When you get things set up in your system for a new TIF area, for an expansion, make sure that they agree with how you have everything flagged. Make sure that they're comfortable with it before you get too deep into it, so you're not looking at settlement time and they're like, well, you're missing all of these parcels that were in our legal description. If early on there's open communication on both ends as to what the composition of the TIF area is, that really helps in the long run. If there are any assessment issues facing parcels in TIF areas, again, communicating with those entities, make them aware of it. I know the county assessor is supposed to quarterly provide a report to every unit on outstanding appeals on parcels. Just work with those units to make sure they got those reports from the assessor and understand if there's going to be any impacts on their TIF areas. And again, if there are any settlement issues you're facing, just communicate that up front with the units. That saves you a lot in the long run. And then also I said, communication with the assessor's office. Assessors most of the time have no idea whether a parcel is in or out of a TIF area. So when they're doing kind of their normal operation of business, they're just kind of doing it within the bounds of their office, and that's perfectly fine. But if you have a little more communication with them as to making sure, I'm looking for growth here because this is in a TIF area. Can you just let me know when this appeal gets settled or when this construction is completed and assessed? I'd appreciate it. Keeping that rapport with them on those topics really helps, because then when people like me call you and are asking, well, what happened with this parcel? You can say, oh, there was an appeal, or oh, there's this new construction, or oh, there's this demolition. That helps. That helps a lot. And if they can give you the heads up on some of those assessment changes, that's always great. Or if there are parcel changes, I talked earlier about combinations and splits. If they can give you the heads up when those are happening, that can allow you to immediately check and make sure that your software system is capturing those combinations or splits, and you avoid headaches down the line. Now, TIF, I talked about earlier, at its core, it's an assessed value tool. And what you're doing is you're trying to grow the tax base to really help to reduce property tax rates. There are a variety of ways that TIF can operate to help to lower property tax rates. If not all incremental assessed value is being captured in a TIF area, if you're not capturing personal property, or if you're passing through incremental assessed value to the overlapping taxing units, that has downward pressure on assessed value or on tax rates. After the bonds are paid off, after your projects are funded, if the TIF area is not needed anymore, the TIF area can be eliminated, or just a higher amount of assessed value can be passed through to the taxing units. Any assessed value that's not captured is added to the tax base of the overlapping taxing units, and that has that downward pressure on property tax rates. As long as your assessed value is growing faster than the maximum levy growth factor, you're going to have lower property tax rates. So that's what you want to aim for. And obviously there's funds and rates that sit outside of that, but as a general rule, that's what you're targeting. You all know the assessed value correlations with tax rates, but I include this on all of my TIF presentations because it's important to emphasize and reemphasize, because I'm sure you've all been in meetings before, and this might not just be limited to TIF, where people say, well, we get more assessed value, that's more tax dollars coming into our coffers, because they're not very familiar with the maximum levy growth factor. The state limits how much you can collect in tax dollars for your general fund, for any basically non-debt fund or non-cumulative fund. So more assessed value does not necessarily mean higher property tax revenues. What it generally means is assessed value increasing at a higher rate than that growth in property tax levies, you're going to see your tax rates go down, and vice versa. If your assessed value is decreasing, you're going to see tax rates go up, and that's just kind of the general operations of how that works. And I know you're all intimately familiar with that, especially now since we're going through budget time and wrapping that up. You've been looking at this for months now. One thing to keep in mind, though, is that that's not a universal rule of increases in assessed value don't lead to additional revenues, because we do have tax caps in effect here in Indiana. And if you are lowering tax rates through having additional assessed value available, that's going to decrease your tax cap losses, because you're going to have lower tax rate, fewer people at the caps, or people losing or seeing less of a credit on their tax bills. So that is a benefit that you will see from that lowering of property tax rates from that standpoint. And you'll see more of a correlation to the decreases in tax rate, increases in tax revenue due to new assessed value in areas that have high tax cap losses. If you're in one of those counties that tax caps really just don't hit you very hard, then you're not going to really see that effect. But if you're in a county that has high tax cap losses, there's going to be more of a one-to-one, where maybe $1 of TIF revenue equals $1 of revenues that would have been split amongst all the overlapping taxing units. But in general, and this is one of the big misconceptions that I hear frequently, is if a TIF area is generating $100 in TIF revenue, that does not mean that that's $100 of property tax revenues that's not going to the overlapping taxing units. That's just not how it operates. You've got to really look on the back end at the assessed value, and a lot of people don't understand that, and it's important for everyone to understand that, because then that helps to better understand the relationship of TIF to the overlapping taxing units, and then for a redevelopment commission, for a community to work with those overlapping taxing units to quantify that impact if there is an impact, and work on ways to mitigate it in a mutually beneficial manner. Again, TIF does not take away funds from other taxing units. It does not explicitly do that. It postpones adding that new assessed value to the tax base, which postpones that corresponding downward pressure on property tax rates, or with rate-controlled funds that are outside your maximum levy. As you know, those are opportunities for additional tax revenue from increases in assessed value. So your CUME funds, the School Capital Projects Fund was always an example of that, but that's going away starting next year. So it's, again, I know I say this and then I emphasize it and then I restate it, but it's just something where I hear it so much, I figure I should reflect that on everyone I'm speaking to. So it's not just this group that hears me talk about this a lot. And then after the TIF area ends, and or if there's a circumstance where you have excess incremental assessed value pass through, that is added to the value of the overlapping taxing units, and everyone sees that benefit. And then here is just, again, re-emphasizing just a few ways that you can lessen those impacts. Only capturing a portion of the TIF. In Knox County, for the Duke Energy Edwardsport plant, 55% of the incremental assessed value from that Duke Energy plant is passed through to the overlapping taxing units. They're only capturing 45% of the assessed value, and that was laid out at the inception of the area and then through all the financing documents explicitly. Or you could pass through excess TIF assessed value. If you're determining, you know, what we're generating in TIF revenues far exceeds what we need to service our debt and fund our projects, we're going to pass through a chunk of that. An example of that I use frequently is Gibson County, Toyota. Over $100 million of assessed value from the Toyota plant is passed through the overlapping taxing units. It's over 20% of the tax base for North Gibson schools. So that's an example of a redevelopment commission of a county that looked at their allocation area and said, we are only going to capture what we need to fund projects, to fund our bonds, to fund other pay-as-you-go projects to benefit the community, and then what we don't need, we're going to pass through the overlapping taxing units. And they work with the school district to keep them updated on what's going on. And it's a great example of how TIF is done right to benefit the units, but also encourage economic development and to fund infrastructure projects that are needed in the community. Another way to lessen that impact is have the TIF bonds be as short as possible. If you can do it in 10 years, do it in 10 years and end the TIF area, or start passing through assessed value. That's something we see frequently is, let's just get this knocked out fast. No one wants to be in debt longer than they need to be. So if you can keep it short and get the TIF area taken care of, let's do that. A few ways just to deploy TIF funds. Oh, and I see we've only got about 5 minutes. Cash funding, so that's building up a balance, then writing a big check. Pay as you go, incrementally paying for projects over time. You can use edit funds or general property tax funds to pay for a project and then reimburse yourselves from future TIF revenues. Lisa can get into the legal mechanics of that, but that's also another common way to utilize TIF. Debt, bonds, leases, installment contracts, items like that. All of those are ways to leverage your future TIF dollars to generate cash up front. And then a lot of times TIF can be used as matching proceeds for most grants that are out there. So that's something that a lot of people don't realize, but it's something to keep in mind. If you can utilize TIF as a 20% match on a grant, go for it. You can use it as a match for community crossings. I know a lot of communities do that. Go for it, because that's a way to leverage those dollars. Just a few, I don't want to get into the specifics on TIF bonds. I'd rather leave time for questions or comments. But these last couple slides just outline some just basics of TIF financings, things to keep in mind, items to be aware of as you're contemplating the issuance of bonds payable from tax increment. I know we've got just a few minutes left. Does anyone have any questions for Lisa or I that we can hit on before we wrap up? Okay. Oh, yes.
To use the funds from a TIF, it had to be used in that TIF area or a contiguous area to the TIF.
Mm-hmm.
Has the state loosened up onto that any as far as, for example, if you had a TIF and then 5 miles away from that TIF, you were wanting to, say, put a boat docks in for economic development purposes.
Sure.
Could you use those TIF funds for that boat dock, even though it's not contiguous to that area?
I'll let Lisa handle that.
I do. It depends on what is in that TIF area. I'll give you an example that I can think of directly that would be proper. I can't think about the boat dock just yet, but if you have a, let's say you have a sewer plant that's 5 or 10 miles away from your TIF area, and you have a new development coming in that requires an increase in the capacity to that sewer plant, otherwise it can't serve that new business, that absolutely, you could use TIF to help increase the capacity of that sewer plant because it directly serves and benefits employers in the TIF area, and you couldn't do it without that. Another example might be you have a major road intersection that is 5 miles away from your TIF area, but it needs to be improved so that semis can get around it and get to the TIF area and the businesses in there, et cetera. That improvement absolutely serves and benefits, and some would argue is directly connected because there is a road between the interchange and the area. So that could also be a proper expenditure of TIF. I can't think of, if there, I guess, are businesses in the TIF area that benefit somehow from there being accessibility from the water, and you could if you could make those findings and make that nexus and connection, then the test is in serving or benefiting the TIF area. So it doesn't necessarily have to touch the TIF area if we can make proper findings that it serves and benefits the TIF area in some way. Any other questions? Well, boat docks, I'm having a hard time with determining how that's going to serve
Just
and
have
benefit.
one more question. Some TIFs that we see are more of a savings fund than an economic development fund where the TIF will get, say, $1 million a year, but they're only spending $50,000 a year, $25,000 a year. Is there anything in terms of trying to end that TIF because it has too much money in it? Any type of arrangements?
Well, I think that comes down to the individual circumstances and how that community views what it's trying to do with the TIF, because it's not uncommon for communities to want to bank the dollars, build up a big balance, and then pay for something out of cash so they don't have to issue bonds. One mechanism that's out there is, I talked about the June 15th, the annual determination of the intent to capture, excuse me, incremental assessed value. As a part of that determination, the Redevelopment Commission needs to make a finding that it needs to capture that value and those revenues to meet its plan to fund obligations, fund projects. And if they're showing that they are collecting more than in terms of revenues being more than 2 times their obligations or their planned expenditures for projects, then that determination gets kicked to the fiscal body, the legislative body, who can make a binding determination that they capture less than what the Redevelopment Commission is saying that they're going to capture the following year. So they can say, well, you can only capture 1.5 times rather than 2 times, and then the balance of the assessed value would be passed through. They can't make that determination, or the council can't jeopardize the ability to pay bonds or anything, but they can limit the amount of assessed value that a Redevelopment Commission is capturing. Otherwise, I mean, and one of the things that the Redevelopment Commission can say is we're banking this for a rainy day, and we don't, here are the projects that are on our list. We don't know exactly what it is, but we're building this balance for that purpose. So in terms of, and Lisa, this may get more in the legal area, in terms of a mechanism where you can just go and say, you're capturing too much, we need to end this, I don't.
Yeah, the test is the 2 times, and what we've recommended to our Redevelopment Commission clients when they're looking at their plan is to actually go in and try to put estimates. Don't just have so broad of a plan that you can't put any dollar amounts to it once this 2 times test came in, and have some estimates for what those projects cost, and look each year at really, are these projects really something that we may do or that need to be done, or are they just pie in the sky things? And really try to be realistic about what your needs are on an annual basis for the purposes of this pass-through test. Any other questions? All right. Thank you for the opportunity.